Welcome back to another episode. I'm your host, Ryan Richards, a residential loan officer and real estate investor based out of Massachusetts and Rhode Island. Today I'm bringing a long overdue solo episode talking about the differences between commercial and residential financing and also how those apply to the investing landscape. How are residential loans, residential investments different than commercial loans and commercial investments? Stay tuned to hear some of the pros and cons that I've learned for utilizing both. So when it comes to buying real estate, obviously one question that comes up is residential versus commercial financing. Both have their distinct pros and cons and their particular applications that make one more advantageous than the other. As a residential loan officer, obviously I've done quite a bit of residential financing and helped many people utilize residential loans to buy property. And as a real estate investor, I've used several commercial loans as well to buy larger multifamily properties, renovate them, and ultimately stabilize and keep them long term. But there are some distinct differences that you should be aware of as you're navigating when to use one versus the other and how they differ from each other. So number one, it's important to classify the distinction between the two. So residential financing has a limitation on it, meaning to take out a residential mortgage, you can only buy a building that has up to 4 units. The benefit of using residential financing, however, is that lenders often look at your qualification for the property based on your income relative to your debts, including the income from the property. Meaning you don't have to have necessarily experience as a real estate investor. You don't necessarily have to have a property manager. You don't necessarily have to have limitations on the property's performance as long as you have enough income to make the bank feel comfortable giving you this loan. So the property doesn't have to perform on paper because you can prove to the bank that you have enough income to make those mortgage payments regardless of how much rent the property generates. So it's less limiting from that side. Whereas on the contrary, commercial financing is much different. Commercial financing doesn't necessarily limit itself to 5 units and up. However, that's the most applicable circumstance for commercial financing. Anything over 4 units, you'd be looking at a commercial loan. What's different on a commercial loan is a couple things. Number one, the bank is looking at you and the property as an overall investment. So the bank's investing in you as well. So that comes down to a couple questions. Number one, are you experienced as an operator? Have you bought multifamily before? Do you own multifamily properties? Have you partnered on deals? Do you own a business? Are you in construction? What things have you done to show the bank that you can buy a big property, 5, 6, 7, 8, 9 unit building, and operate it efficiently? Because ultimately, if you're not able to operate the property efficiently, obviously you could end up losing money, and the bank doesn't want to give loans to people who can't pay them back. So your experience comes into play. Number two, the property's performance comes into consideration. So as much as the bank is looking at you as well as another financial backer of the loan, they want to see that you have solid credit, solid financials, and experience. They also want to see that the property sustains itself. So banks will typically limit you on a commercial loan to the property's performance. So if a property is, let's say, on the market for $1 million, if the property doesn't bring in enough rent, the bank might only lend you $600,000 because that's the biggest mortgage they can give you that they feel comfortable in the rent sustaining and covering. That's typically what we call the debt service coverage ratio. How much does the rent exceed the mortgage payment is essentially the calculation. So you're limited by the property's performance. And that's something that's different than residential, because residential, you could buy a 3 or 4 unit building regardless of if the building's rented or if the building even will be a good investment, because the bank's very comfortable that you have enough income and enough assets to pay it back regardless. Whereas commercial is more concerned about you as an operator. They want to see that the building sustains itself, that you're a proven operator, you have experience to be able to manage and get the property performing the way it should be. So kind of different in that realm. But what's also important to note between the two types of financing is the flexibility. So typically residential loans fall within a box for the most part. A lot of lenders use Fannie Mae, Freddie Mac guidelines for a lot of the conventional residential lending. What does that mean? Typically less flexibility and more paperwork. So typically, if you're buying a 3 or 4 unit building, it can be very difficult to get a residential loan that also provides construction funding on a renovation project. And if you are able to, typically there's a lot more red tape and documentation than you would need on a commercial loan. It's not a common product, it's difficult to find and can be difficult to use. Whereas on the commercial side of things, it's a lot more flexible, especially once you're able to build a trusting relationship with your commercial lender. Because once they know your finances, your profile, they've seen that you can operate, maybe you bought multifamily with them before, the properties are performing, you executed efficiently, you communicated efficiently, there's a strong likelihood that you're going to be able to do that again. So the process becomes a lot easier. Getting renovation funding is a lot easier. The process becomes more streamlined because they've already vetted you. So now they just need to vet the new property that you're buying. Look at the capital you have in the bank and prove that this property you're purchasing is a good investment. Show them the roadmap. What's your business plan? Like when you take over a property on day one, what are you going to do for the next 90 days? They want to know these types of things. Like, why are you buying in this area? Not just because you saw a deal on MLS and you wanted to buy it. Have some investment thesis. They want to know that you've thought about the investment, you've laid out a blueprint, and that they can get behind your ability to execute that plan. So definitely different from that perspective. But what's also important to note are the differences from the investment side of commercial versus residential real estate. For example, residential real estate typically trades and properties typically sell based on the other comparable sales in the area. So what did the 3-family sell for down the street? What's the square footage? How many bedrooms, bathrooms, compared to the property that I'm buying? It's relative to the data in the area, property to property, to get a rough estimate on sales price. Now, what's different in commercial property is that properties trade primarily based on, and they're valued primarily based on the income that the property generates. So your ability to increase the value of a commercial property can be much higher and much, not easier, but more achievable because of this fact. Artificially, let's say you buy a property that's $1 million property. The rents are well below market. There are old tenants. They're paying $500 a month. If you go into that property and you increase the rent roll with some light cosmetic updates, you could increase the value significantly. Versus if you had that same property instead of a 10 unit, it's a 2-unit property, you going in there and increasing the rents doesn't make that property worth nearly as much more on a multiple basis because you're still limited relative to the other properties that have sold in the area. So just because your property brings in more rent than the one down the street, if it's the same age, same square footage, same location, same bedroom, bathroom count, it's not going to sell for that much different. But on the commercial side, it's very different. Your property's income directly correlates to the value. So if you can cut expenses, if you can increase the amount of rent your property generates, you have a lot more ability to increase the value very quickly. So for that reason, I myself am actually leaning more towards commercial assets because you have the ability to drive the value much quicker, much more efficiently, and they give you some sort of cushion. So larger properties, if let's say you have a 10-unit building, one tenant doesn't pay their rent, or say 2 tenants don't pay their rent, there's still 8 other tenants who can pay their rent and provide you the income you need to cover your mortgage payment. Whereas if you buy a 3-family, typically you're relying on all 3 units to pay the rent to make any money. And if you lose one tenant because they're behind on their rent and you have to evict them, those other 2 units may not cover your mortgage payment. Whereas a larger property typically has a little bit more cushion from potential loss of rent. So I like that factor as well. Now, obviously, we just scratched the surface on this topic. We could go into much more detail on some of the specific differences, pros and cons on specific applications, but hopefully these few examples were helpful for you as you start to navigate the process. As always, if you have questions about getting started in real estate, different types of financing or loan structures, reach out to me and I'd be happy to talk with you more about it. See you on the next one.